VOO versus VTI, the SmackDown. Know the difference before you invest is an article someone sent to me from Seeking Alpha. All right, Seeking Alpha. Dateline just the other day, November 3rd, 23rd, 2020. Let's see. Talk about Warren Buffett. As long advocate the retail investor should invest in a broad market index fund, but which one? The choice comes down to funds that track the S&P 500 and those that track all of the many more thousands of stocks that make up the U.S. stock market. This article compares the two Vanguard ETFs. All right, so let's take a look. We're just going to fast forward a bunch here, and we're going to go down to since inception of the Vanguard Total Stock Index, VTSMX, and VFINX, the Vanguard 500, which goes back to 1992. And not much of a difference there. Total return is 1,407 cumulative for the S&P 500 and 1,438 cumulative for the VTSMX. So it looks like the total stock market did a little bit better than the S&P 500 index. There have been times when buying the one fund would have given you a better long-term return, but just as many times when the other one have done so. So basically, they're the same going back to 1992. The differences were very small. You made an extra $3,000 if you had the total market than the S&P 500. All right, looks good. The 10-year return, almost the same thing there. VTI was up 260.08. VOO was up 260.92. So the total stock did a little bit better than the S&P 500. But the past is history, says this guy. How do they differ? If you look at the information provided by Vanguard, the most obvious difference stands out. The VOO holds far fewer stocks at 508, which makes sense because it tracks the S&P 500. VTI is superficially far more diversified in that it holds 3,590 stocks. Where are you going, Pablo? Which are supposed to represent the entire investable U.S. market. Because of the 1,000 more stocks it holds, each stock in the VTI has less impact on the share price as a whole, which I kind of like. As a result, VOO's top stocks make 28.9% of its total holdings. In contrast, the top 10 of VTI make only 23.7%. The top 10 are identical, by the way. To see what the long-term effect of VOO's top heaviness might be, I took a look at how you would have done buying these two funds in the past when valuations were very stretched. March 2000, and then which was the end of the dot-com Y2K bubble. All right, below you'll see the 5-year results you would have experienced if you just bought the mutual fund versions of these because ETFs did not exist back then. So here it looks like VTSMX was down 12.58%, where VFINX was down 15%. So the total stock market did better in the down market. You would have lost 2.6% less with the total stock index. I'm not sure if that's annualized, and them might be annualized. Performance after a boom shows the benefit of the broad market index funds and the total stock fund. Looking back at 2000, it becomes clear why you benefit from owning a broad market. That's because the stocks that dominated the S&P 500 and probably the total stock index. Oh, there's Finney. Hold on a second. Let's pause. Let's see. That's because the stocks that dominated the S&P 500 and probably the total stock index too, which they certainly were very different from those dominating now. The Microsoft was the only stock that appeared in the top 10 of the S&P 500 back then that still appears in it now. The other stocks back then, GE, the number one stock in the S&P, Citibank, AIG, Exxon, Cisco, all of which have checkered history since 2000. I wonder if Enron was in there. Had you bought and held a portfolio made up of mostly individually bought popular stocks, you'd have had some very lean years going through forward, especially after the financial crisis. Meanwhile, those who own the indexes already own today's leading stocks online, or leading online stocks. Oh boy. Apple, Alphabet, NASDAQ, or Google, Amazon, they were bit players in the market in 2000, and you got to profit from the rise. That's why I completely agree that total stock is the way to go. I could not find a listing of the top 10 stock markets in the total stock index in 2000, but I assume it's probably very similar to that the S&P 500. Yeah, I'm sure it was too. Let's see. The advantage you would have gotten owning VTSAX, the total stock, after 2000, extended through the financial crisis through the recovery 2013. Finn! Ow! And by 2013, the advantage of owning the total stock index had become pronounced, with a fund having a 12.9% advantage over the Vanguard 500 in those times from 2000 to 2013. I bet it's different now, though. But the S&P leads again. But that advantage ended with the market recovery 2013. Since then, the Vanguard 500 fund and VTI have had the edge. Well, the Vanguard. Oh, VTI. Stop VTI. Finn, stop. Ow. Ooh. And the Vanguard 500 fund and VTI have had the edge. That doesn't make sense because VOO is the Vanguard 500 index, where VTI is a total stock index. I don't get what he's saying there. Vanguard's few valuation metrics don't tell us much. So much for past performance. We can't invest in 2000, only 20. Okay. And he look at PE ratio about the same, price to book ratio about the same, ROE, earnings growth rate. And then the fund assets, VTI's got 921, VOO is the S&P 500. I think he messed that up right there. He should have said VOO. Since 2013, the S&P 500 has done better than the total stock index because it's dominated by a few of the performers. But when those things change, the VTI will outperform most likely. All right, that's okay. I'm not all that. That's fine. I just think that the key to this right here is that if you would have had VTI or VTSMX, the exact same thing, back in 2000, you would have owned Apple, Google, all those, Amazon, all those companies, where you would not have owned that in VFINX. And as such, you want more broad diversification just because you don't know what the next Google is going to be. And so if you have the total stock index, you're going to have that. You'll have more crap stuff in there too that'll go kaput. But because it's broad-based, it's spread over, what do you say, 3,600 stocks, there's less downside risk. And, frankly, there's more upside limitations because each of those stocks represent less of a proportion of the total index. But that just narrows your investment risk, but it makes you potentially have higher returns simply because you're going to have more exposure to companies that are small now but can grow big in the future. I mean, that's what I have, a VTI, and that's what I recommend people have, to have access to a diversification through small, mid, and large companies, not just mid and large companies. Love to hear your thoughts. We'll see ya.